Well, hello folks, I'm L.A. Little and this is your weekly NeoTA wrap. We take a look at these markets and we do it from a neoclassical perspective, each time asking ourselves what happened last week and what does it tell us about the coming ones. I do this show once every Sunday night, broadcast at or before 10 o'clock Eastern Time, archived on YouTube, the son of a channel L.A. Little. You can subscribe there, get content not so much pushed to you, but the notification of content being pushed to the site, and you can stay up to date with what we're doing. As far as these markets, it was a down week. Last week, once more, we saw the Dow, NASDAQ, S&P, all of them down. They're all about 2% lower on the year. 2 weeks in, 2% lower, percent a month, or percent a week so far. As far as the equity markets and what they look like, the strength is in the weeklies, and it's still holding up when we look at those weeklies right across the board. As I show you here, or as we look here, you can see push down into this prior swing point high. If you draw out that retest regenerate zone, you can see that it's coming into it, it's holding it, and it's holding it not only on this index, but it's holding on all of them. For example, if I look at the Dow's holding it. The NASDAQ, right? They're all doing the same thing. They're all coming back into those prior highs, and they're holding right there at those highs. We're not seeing an expansion of volume on the way down. Every one of them holding where you would expect. The one thing I would note to you, bring to your attention, is for a while there we've been watching that December 18th bar, this big bar. That was the Fed bar. So the Fed bar was here, you had to carry through the next day. That is kind of the demarcation between the various zones. And so if you draw these zones in, right, you kind of got a top zone, a middle zone, and a lower zone. And we had popped into the lower zone, looked like we were going to stay there. Well, it's just inching back up into the middle one. That's going to be a key point this week when we look to see whether or not this market can actually push back up on a daily basis and eventually on the weekly basis into this middle zone again, or are we finally going to see a breakdown in this market, something which hasn't come to pass as of yet. If we look back at last week and we ask what were the big events, well, clearly it was financials, and it was the Swiss, as they took and decoupled from the euro. Let's look at the financials first. If we look at the XLF on a daily, you can see the breakdown off the swing point low. That breakdown turned the trend to sideways from bullish. So that's the retest, bearish retest regenerate zone. On the way back up, had a lot of volume on Friday, so you left volume down here into this big bar. Wasn't enough to break it down though, so a bounce in order. I would expect some sort of a bearish retest regen back up into this area. Note you had an ABCD structure on the way down from there to there. Actually, let's draw it with this so it's a little cleaner. So we had from there down and back down. It finished off that ABCD structure and now is doing its bounce. What can you expect for it to do? Well, come back to the retest regenerate zone, either at the bottom end of it, somewhere inside of it, maybe all the way to the top, and then try to do another ABCD structure to the downside to get it down into those October lows. That's the way the XLF has set up, and if you look at it on the weekly, that XLF, as ugly as the week was, it did not give up the retest regen bullish on this time frame. So at this point, if you're an investor and you're looking at this market, you're saying, hey, this thing's still bullish. When I look out a little bit farther on the time frames, it's still a bull trend. I should still be buying, and to some degree I believe that's what's happening, and that's going to continue to happen until what? Until they actually get a break and it's no longer an uptrend. And so far that's not the case here. It's certainly not the case in the biotechs. It's even not the case when we look at things like the IYT, the transports, the XLI. You can go down the list. They're all holding. They're all holding their bullish retest regenerate zone. You can see the swing point high here. You can draw it out and you can see what I'm talking about. It's holding right there on every one of them. That keeps this market bullish. That's what's holding it up, and that's what's keeping investors from really doing any kind of serious selling. Part of that, of course, is the expectation that the ECB is going to roll out QE. The Swiss told us that was the case because the Swiss franc was decoupled from the euro, appreciated 20+%, looks like 18.35% off those lows. Huge move, right? Blows away all these swing point highs all the way up. I've never seen a move like that in a currency. That decoupling has put significant pressure again to the downside on the FXE. You can see it here, big volume spurt. That's the sort of thing you typically see on some sort of a blowout move that sets up the range trade on these currencies. Now, if the euro is going to range trade, then what does that tell us about the ECB and the quantitative easing that they're about to unleash? It seems to suggest that it's already baked into the cake. And if that's the case, are equities going to behave the same way that currencies are already starting, or are they just getting started? That's really the question, because if we look at the world markets and we pop over to, say, Germany, the strongest of the European economies, you can see they are making new highs already. You can see France is coming after a swing point high on the weekly. There's 3 of them lined up on the way up. Are we going to see a situation in France, in Germany, like we saw in Japan? In other words, are we going to see a moonshot up 20, 30, 40% like we saw elsewhere in the Nikkei, for example? Here's the Nikkei on a monthly. That broke away. Well, the lows back when it all started was 8,000. Now it's 17. You know, that's a doubling in the price over the last 2 years. Is that what's coming? Is that what's going to drive the next leg in this unrelenting bull market that is mostly driven specifically off the central bank actions and the various government actions to also prop up these economies? That certainly is what looks to be the case, and you know, that, well, looks to be the case in that that is what is expected to be the case, and that's why folks are piling in right now on the ECB action or expected action. That action, you know, if you look at the news that's getting leaked, it's suggesting that the way they're going to get around the German objections is to make it so that the central banks of each of the countries can buy up to 25% of the sovereign debt of that country only. So in other words, the Germans would buy German debt, the Italians would buy Italian debt. That could get past the German objections, and then of course if they hold some of that risk, then you're going to see, you know, those countries participating less or more depending on what they think they need to do. The interesting piece of that is if you do it that way, are you going to get a big enough package? In other words, is the Italian central bank going to wade in there and buy its full 25%? Is it going to buy just 2 or 3% or 5%? The package, right? I mean, that's why Japan made this huge move. It was this huge, overwhelming package to devalue their currency at a rate that was unheard of. If the European Central Bank, if the package they're rolling out is such that the take rate as to how much sovereign debt actually gets bought isn't that great, then I don't think you're going to see the kind of impact you saw here in Japan. Surely there'll be some impact, but is that already priced in? That's what we're going to find out. We're going to find out what that package really is on Thursday, and we're going to find out how much of it already is baked in. And looking at the currencies, it looks like the majority of it may already be baked in. Moving over back to the OX markets, if I look at the EEM, this struggling, the countries that are struggling are the ones that are tied to commodities. And so if we speak of commodities, let's start with oil because that's where the big pain has been. Another new low, although it did do an under over, and on a daily basis it actually tested the lows and got a push back up. This looks like it's ready to finally bounce, and if it does, that's going to help the energy sector get a pretty good bounce going. On the currency, flipping right back, the UUP still hasn't shown a top. The bonds still haven't shown a top. And if we look at gold and silver, silver is coming after that swing point high to get it out of this bearish mode it's been in. And that would simply follow what gold has already done, because gold, let's grab the gold market, gold has already made that push. So if I look at the gold market, it's no longer a downtrend. Swing point high here, it's gotten over with a push over it now, right? Breakout, volume expanding, change to a sideways trend. Where's it going next? It's going to try to take that swing point high out. If it does, what does that do? That changes the whole picture, because that would say it is an uptrend on this time frame. We haven't seen that in a couple of years. So gold, nice picture, nice setup. It's done its ABCD. I would expect, well, usually you would expect some sort of a pullback, but this one is an emotional market right now. Volatility's high, not only in equities, not only in currencies, also in these commodity markets as well, as we've seen with oil, with gold, with all of these. And speaking of another commodity market, copper takes a huge plunge last week, right? Finishing off a nice big move to the downside there. And so everywhere you look, there's disruption. And folks, in my opinion, it's based on ECB, and not ECB, but central banks around the world, and the continual pushing of the string, so to speak, here on the equity markets. They don't want to give it up. They want to keep pushing them up. That's their ticket out of this mess that they're in. And frankly, I don't know how it's going to end, but I suspect it's not going to end good when it finally does. So, where are we at? Well, we're at the same place we've been, and that is that you still have to lean bullish if you're leaning. You can't lean too far because it's a toss-up right now. And matter of fact, it's all coming down to earnings and the ECB. Earnings, as we saw with the XLF, have traded lower. Here's the XLF coming down. They held on the weekly, but if you look at them on the daily, they finished an ABCD down, broke the swing point low. Yeah, they're probably going to get a bounce, but they're pushing lows with volume. And if you look at any of the stocks inside this group, I'll just pick on JPM as an example. Total breakdowns, these stocks are done for the next 3 months. So the financials aren't going to help this market higher. The energy is going to bounce for now. If you look elsewhere, it comes down to other large sectors, in particular technology, and that's where the earnings are going to matter this week as the tech companies start chiming in. Are they going to get a push back up and actually carry this market? Or is technology done as well? Folks, we haven't seen a correction in 3 years. It will come. Maybe this is the time. We'll know more as this week plays out, as the ECB decides what it wants to do, and as the earnings keep rolling out. The big bulk of the earnings the next 3 weeks is going to tell the tape for the first quarter. I'm going to leave it at that for tonight. I'm going to be off tomorrow night. Markets are closed here in the U.S., so I'll be taking the night off, and I'll be back with you on Tuesday. Have a great one. Thanks.